Okay, in this series of videos, we're going to take a look at measures of cash flow, and we're going to particularly focus on this notion of free cash flow. So let's build our way up to that and start with just talking about looking at measures of cash flow besides what we see in the statement of cash flow. So the statement of cash flows gives us important information about cash flows. Again, it explains primarily what has happened to cash over the course of the year. But there are some other measures of cash flow that we frequently use, and analysts will use, creditors will use, managers will use. So we're going to talk through a variety of different measures here. We're going to start with net cash flow. That's defined as net income minus any non-cash revenues, add back any non-cash expenses. Now, frequently, either the non-cash revenues are nothing or they're negligible, and non-cash expenses other than depreciation and amortization are frequently negligible. So if we eliminate those two things, we come up with this next equation that's probably the most simplistic and the most useful measure, most frequently used, I should probably say, measure of net cash flow. And that is net income plus depreciation and amortization. So you take net income, add back in the depreciation and amortization expense. So this is cash flow that a firm is generating that isn't affected by their investments that they frequently will make in fixed assets and in working capital. So it's a starting point for some of these other cash flow measures that we're going to look at. So let's just move on and talk about free cash flow. So there's two different ways that we can calculate this measure. The first one we're going to look at is how cash flow is generated. The second measure is how free cash flow is used. And those two numbers, by the way, should be the same. So let's talk about how we come up with a cash flow. I should be more specific, a free cash flow measure. Yeah, that term is very important, free cash flow. So we're going to talk about how to calculate that. So we're going to start with this number called NOPAT, net operating profit after taxes. So it is, in effect, the big bucket that we're going to be using to fill up our investment buckets. And then whatever is left over, we're going to term free cash flow. So NOPAT is equal to earnings before interest and taxes, EBIT, times 1 minus the tax rate. So in this case, with this example here, we've got EBIT of 500. We can look at the relationship between between pre-tax earnings and taxes and infer what that, or determine what that tax rate is. In this case, it's 40%. So we multiply 500 times 1 minus the tax rate, 1 minus 0.4. So we end up with a result of $300 here. And that is our NOPAT. That's our starting number as we work towards how free cash flow is generated. So next we're going to take away some things. The first thing we're going to take away is net operating working capital. And then we're going to take away the investment in fixed assets. So we're going to start with this notion of net operating working capital. And down here at the bottom, that's equal to the operating current assets minus the operating current liabilities. Now I'm emphasizing this word, or trying to emphasize this word, operating, because it kind of delineates some of the current assets from others. So operating current assets are things like cash, receivables, and inventory. They don't include financial things. So if we had short-term investments or cash equivalents, we would not include those. We would ignore those. And likewise on the current liability side, we want to focus in on the operating current liabilities. So accounts payable and accruals would be examples of that. We're going to ignore things like notes payable because that is a financial current liability. It's not operating, it's financing. So we are going to just focus in on the operating current assets, operating current liabilities, and the difference between those two numbers, we're going to term net operating working capital. So that's our first thing that we're going to look at. And what we need to do is look at the change in net operating working capital from one year to the next. That's going to tell us the investment in net operating working capital. So let's look at what's going on with free cash flow here, and particularly the investment in operating working capital. In 2018, the most recent year, we look at the operating current assets. That's going to be the cash over here, the receivables and the inventories. Together, that's this portion right here, 1550. We subtract the operating current liabilities, the accounts payable, and the accruals. So we're taking away 500 from that. And the net operating working capital for 2018 is at 1,050. Now, if we go on and look at 2017, we would see that the operating current assets are going to be the 60 plus 380 plus 820. and we're going to take away the 190 of accounts payable, the 280 of accruals, and we net out 790. So what we are left with is this net operating working capital for 2 different years, and we want to see what has happened. What's the change been in that net operating working capital category? So in this case, it's gone up by 260. That means that the firm has invested 260, in this case we're talking about millions, $260 million into operating working capital. So that's a use of their, it's coming out of their operating cash flow, that NOPAT, and so it's going to be an investment that they're making. So let's move on to property, plant, and equipment. And in particular, we're going to look at the net property, plant, and equipment. And so we are, in this case, focusing in on the change from 2018 to 2017. If we look over here at 2018, the PP&E was 2,000. The net PP&E in 2017 was 1,700. Therefore, it's gone up by 300. Therefore, the firm has invested $300 in net fixed assets. So we got these two investments that the firm has made, one in operating working capital, one in net fixed assets. And so as we pour money out of our starting bucket, fill up these other buckets, what we're left with, we're going to define as the free cash flow of the firm. So in this case, we start off with $300 in NOPAT. We take away the working capital investment. We take away the fixed capital investment. And we're left with free cash flow of negative 260. All right, so we're going to move on to looking at how free cash flow is used. And again, this method of measuring free cash flow should give us the exact same number that we had from how free cash flow is generated. So let's talk through here. We got 5 uses of free cash flow, 5 good uses of free cash flow that we're going to look at. And I'm going to emphasize the word uses here because we're thinking about cash flow going towards these things. So as we look through the examples, I'll pay particular attention to the sign of the cash flow, the direction of the cash flow. And we do need to keep that in mind because it's a little bit different than the statement of cash flow, so we got to be careful. So the first use of free cash flow is to pay interest to our debt holders. And we need to keep in mind that there is a tax benefit to interest paid. The interest paid that a firm has, it reduces their taxable income, so there's a tax savings involved with paying interest. So we're going to look at the after-tax cost of the interest paid. We can pay down principal to the debt holders. That is, we can reduce debt. So that would be another potential use of our free cash flow. We can pay dividends to shareholders. We could repurchase stock from shareholders. That is, we could reduce the equity by paying them money, getting back shares of stock. And then finally, we could buy short-term investments, and that would be a way to park some of our excess cash. So those are the 5 uses, and let's just, again, walk through the example for this firm that we have and see how things were used. So in this case, the interest paid was $120. That's from the income statement. We know that the tax rate is 40%, so we multiply that times 1 minus t to get the after-tax cost of the interest paid. That is $72. And this is a use of cash. This is cash flow going to the bond holders. So we're going to have a positive sign here. This is a use of cash. It's not a source. So positive in this particular context, in this setting, is going to be a use of cash. So it's almost the exact opposite of when we look at a statement of cash flows. Paying out interest would be a use of cash, but it would be assigned a negative sign. In this context, we're using a positive. All right, next, paying down principal. If we look at notes payable here, in 2018 it was $280. In 2017 it was $130. That means we haven't paid down principal. In fact, we've borrowed more money. So notes payable has gone up by 130. Sorry, it's gone up from 130 to 280, so it's increased by $150. Likewise with long-term debt, last year it was $1,000, this year it's $1,200. It's gone up by $200. So it's not that we've paid down debt, but rather we've borrowed more money. So this wasn't a use of cash, which we get a positive sign. Rather, we were sourcing cash, and so the cash used here is negative $350. Again, it wasn't used, it was sourced, so we're going to assign that an opposite sign, the negative sign. Okay, on this last slide of this video, we're going to look at the use of free cash flow for paying dividends. So in this case, we have 2 different sets of dividends we're paying. We paid some dividends to the preferred shareholders, and we paid dividends to the common shareholders. In total, that's 58. So again, this is a use of cash. We did pay that money out, so it's a use of cash, so we have a positive sign here. And that is the third thing. And before we go on, I'm going to go ahead and stop this video because we're at about 10 minutes, and I'll pick up in the second video looking at these free cash flow measures, and so I will see you then.